VAR Energy, ASA, listed on the Oslo Børs, represents a compelling investment thesis centered on predictable high shareholder distributions and eminent, structurally de-risked production growth within the premium operating environment of the Norwegian continental shelf. The company has successfully executed a transformative growth phase, translating ambitious capital expenditure (CapEx) into sustained long-term cash flows that are shielded from excessive tax liabilities by the unique Norwegian petroleum fiscal regime. The investment appeal rests on three primary pillars. 1. Operational de-risking through ahead-of-schedule project delivery, establishing a robust production plateau toward 2030. 2. Financial certainty, underpinned by a guaranteed $1.2 billion fixed dividend for both 2025 and 2026. And 3. Significant valuation upside, indicated by intrinsic cash flow analysis. The company's ability to bring 7 out of 9 planned growth projects online in 2025, including major fields like Johan Castberg and the Jotun FPSO and Balder, has significantly improved the confidence in future volume projections. This success positions VAR Energy to generate substantial free cash flow (FCF) through 2026 and beyond, supporting its fixed dividend commitments while maintaining aggressive investment in low-cost, high-return developments, average project break-evens below $35 per barrel of oil equivalent, or BOE. Investment thesis snapshot. VAR Energy is categorized as a high-yield, disciplined growth vehicle operating in a best-in-class regulatory jurisdiction. The company's long-term competitive advantage is anchored by industry-leading low unit production costs, a strategic commitment to decarbonization, net zero operational emissions by 2030, and an effective CapEx strategy that utilizes the Norwegian cash flow tax system to maximize post-tax shareholder returns. Price target. Based on the robust operational performance, secure dividend yield, and compelling valuation multiples relative to its eminent cash flow expansion. Consensus estimates from 14 analysts set the average 12-month price target at NOK 39.14. Compared to the valuation assessment, which estimates a fair value of NOK 55.39 via discounted cash flow models, the current trading price implies a substantial intrinsic undervaluation of approximately 38.5%. The consensus price target alone suggests a potential upside of 16.05%. Corporate context and operational fundamentals, the NCS advantage. VAR Energy is positioned strategically within one of the world's most attractive and reliable exploration and production E&P regions, the Norwegian continental shelf. This positioning affords the company distinct advantages in stability, resource quality, and operational efficiency, setting it apart from international peers operating in more volatile or less developed regulatory environments. IVA, strategic positioning on the Norwegian continental shelf. Norway benefits from a modern, highly developed economy, political stability, strong property rights protection, and an effective legal system, making it a safe and straightforward place for international business. While recent tax proposals on other sectors have introduced moderate regulatory uncertainty, the poor framework governing petroleum activities remains stable and predictable. VAR Energy leverages this environment, operating as one of the fastest-growing oil and gas companies globally and serving as a major gas supplier to the crucial European market. Asset portfolio and resource base. VAR Energy's operational footprint is extensive, encompassing equity stakes in 42 producing fields and offices across key Norwegian cities. The company's access to future exploration acreage is secure, spanning the North Sea, Norwegian Sea, and the Barents Sea. Critically, the company sits on a vast resource base exceeding 2.1 billion BOE of net proved plus probable reserves and 2C resources. This massive resource potential provides the long-term foundation necessary to sustain high production levels well into the next decade. Decarbonization commitment and ESG leadership. In alignment with European energy transition priorities and Norway's strong regulatory push toward environmental stewardship, VAR Energy has made firm commitments to ESG leadership. The company's strategy explicitly targets becoming an ESG leader and achieving net zero operational emissions Scope 1 and 2 by 2030. The company believes that producers who can deliver hydrocarbons with the lowest possible emissions and costs will possess a competitive advantage. This aggressive decarbonization pathway positions VAR Energy favorably with institutional capital, reducing future transition risk compared to peers in jurisdictions with weaker environmental regulations. The tangible plan involves reducing emissions from current operations by more than 50% by 2030. IVB, Production Transformation and Sustained Growth. The year 2025 marks a pivotal moment in VAR Energy's corporate trajectory, characterized by the successful transition from a high capex development phase to a sustained high production phase. Project delivery success and Q4 production peak. VAR Energy has delivered transformational growth ahead of its internal schedule, successfully bringing 7 out of 9 major growth projects online in 2025. This success includes the ramp-up of key assets such as the Johan Castberg field and the Jotun FPSO at the Balder field, both of which achieved plateau production levels during the third quarter. This successful execution has significantly mitigated execution risk across the portfolio, thereby de-risking the future production outlook. The output from these new projects adds approximately 180 kbopd at peak in 2025. This ramp-up supports a significant surge in expected average fourth quarter 2025 production, projected to reach approximately 430,000 BOPD. This output surge positions the company solidly within its full-year guidance range of 330,000 to 360,000 BOPD. Long-term production sustainability and resource conversion. The strategic objective is to stabilize and sustain production in a high band of 350 to 400,000 kbopd through 2030. This long-term target is not speculative, it is structurally supported by two critical factors, the massive 2.1 billion BOE resource base and a prolific project pipeline. The company is currently accelerating infill drilling, increasing exploration activity, and moving more than 20 early-phase projects forward faster, aiming to sanction up to 10 new projects in 2025, with 4 already moving forward. The operational strength of VAR Energy is demonstrated by its successful conversion of contingent 2C resources to proved 2P reserves. The proactive approach and successful execution of the 2025 startups indicate a robust project management capability, providing confidence that the 350 to 400 kbopd long-term target is achievable and sustainable. Strategic asset expansion. A concrete example of disciplined strategic growth is the increased ownership interest in the Ekofisk PPF, previously produced fields. VAR Energy increased its stake from 12.388% to 52.284% through the acquisition of Total Energy's interest. This transaction is immediately accretive, adding an estimated 38 million BOE of net proved plus probable reserves with anticipated low operating costs. Management explicitly stated that this move supports the ambition to maintain production levels between 350 kbopd and 400 kbopd toward 2030, reinforcing the company's hub strategy in the greater Ekofisk area. Operational efficiency as a competitive moat. The economics of the VAR Energy portfolio are highly attractive. The low operating costs provide an inherent resilience crucial for navigating volatile global commodity markets. Unit production costs were reported at $10.6 per BOE in Q3 2025, with management expecting costs to settle around $10 per BOE in the fourth quarter. Furthermore, new projects possess average project break-evens estimated below $35 per BOE. This efficiency directly translates into superior cash flow generation capacity and allows the company to maintain profitability and service fixed dividends even in a scenario of moderate commodity price decline. Financial performance and capital structure analysis. VAR Energy financial structure reflects a company prioritizing high capital reinvestment to secure long-term production, while simultaneously managing the inherent complexities of the Norwegian tax system to maintain aggressive shareholder returns. 3A. Income statement, cash flow, and cost structure. The third quarter of 2025 demonstrated solid operational results, though reported net income was affected by fiscal obligations. Net income for Q3 2025 was $152 million, which fell slightly below the analyst consensus of $179 million, primarily due to higher taxes. This highlights the necessity of evaluating the company based on cash flow metrics rather than traditional net income, given the high statutory Norwegian tax rate discussed further in Section V. Robust cash flow and liquidity. Despite high investment levels, the company delivered substantial cash flow from operations (CFO) of $1.2 billion in Q3 2025. This strong operational cash generation supports management's confidence in sustained returns. VARRY Energy maintains a disciplined capital structure, reporting reduced net debt and substantial financial flexibility, underpinned by $3.6 billion of available liquidity. This high level of liquidity provides crucial balance sheet protection, strategic optionality for acquisitions such as Ekofisk PPF, and significant headroom for both dividend payments and further deleveraging. Natural gas realization. A contributing factor to the robust cash flow generation in the third quarter was favorable gas prices. VARRY Energy realized strong pricing, with approximately 18% of its gas volumes during the quarter sold at an equivalent of $90 per BO. As a significant gas supplier to Europe, this strong pricing environment further stabilizes and enhances gross CFO. 3B. Capital expenditure, CapEx roadmap, and investment economics. VARRY Energy is currently executing a strategic high CapEx cycle designed to maximize future cash flow and long-term production sustainability. The capital allocation strategy is highly disciplined, focusing exclusively on projects with highly attractive internal rates of return (IRR) and low operational break-evens. 2025 CapEx commitment. To meet its ambitious growth targets, the total estimated capital expenditure for 2025 is projected between $2.8 billion and $3.0 billion. This includes development CapEx guided between $2.3 billion and $2.5 billion, approximately $400 million allocated to exploration, and about $100 million for abandonment activities. This substantial spending level is necessary to bring the 9 growth projects fully online and secure the planned 430 kbopd peak production rate in Q4 2025. Long-term capital discipline. Management has articulated a clear CapEx roadmap for the medium term, demonstrating continued investment discipline even after the current peak. The average annual CapEx target for the 2026-2030 period is maintained at a high level of $2.0 billion to $2.5 billion, excluding exploration and abandonment. This ongoing investment ensures the sustained production target of 350 to 400 kbopd is achieved and decline rates across the portfolio are effectively managed. High-quality project economics. The integrity of this capital deployment is validated by the project economics. The pipeline of new projects, including the 30 early-phase developments, focuses on high-return opportunities. Average project break-evens are estimated below $35 per BO. This low break-even level, coupled with an estimated internal rate of return greater than 25%, ensures that capital is deployed efficiently to create long-term value even if commodity prices moderate. The high CapEx level in 2025, particularly the $2.8 to $3.0 billion spend in 2025, is strategically important. Under Norway's cash flow tax system, discussed in Section V, the ability to immediately deduct these substantial investments against the tax base provides a crucial tax shield. This shielding effect minimizes the cash tax rate paid during the development phases when the projects are most expensive, thereby maximizing the free cash flow after tax available for shareholder distribution. The high CapEx level is therefore not solely an expense, but a critical tool for optimizing post-tax cash realization, which structurally supports the fixed dividend commitment. 4. Dividend sustainability and shareholder returns. A core component of the investment thesis for VAR Energy is the predictable and substantial level of shareholder remuneration, which is explicitly guaranteed for the next 2 years and supported by strong underlying cash flow dynamics. 4A. Dividend policy and fixed guidance. VAR Energy differentiates itself through a highly attractive and predictable fixed distribution schedule. The company has maintained a fixed dividend guidance of $1.2 billion for the full year 2025 and reiterated this same guidance for the full year 2026. This commitment is paid out in quarterly installments of $300 million. This predictable distribution results in an exceptionally attractive current dividend yield, estimated at 15% based on certain trailing metrics and pricing, and a robust forward yield of 7.35% as of late October 2025. This high fixed yield transforms the investment profile from a traditional cyclical E&P stock into a robust income instrument. By guaranteeing these distributions, management signals high confidence in both their operational ramp-up and the effectiveness of their financial and tax shielding strategies. For the longer term, beyond the fixed 2026 guidance, VAR Energy's official dividend policy reverts to distributing 25 to 30% of cash flow from operations after tax over the cycle. 4B. Dividend coverage analysis. The key test of the fixed dividend is its coverage by current and projected free cash flow, FCF. The evidence strongly suggests the dividend is fully covered even before the maximum benefit of the Q4 production surge is realized. 2025 coverage assessment. The required annual dividend payout is $1.2 billion. As of the end of the third quarter of 2025, VAR Energy had already generated actual free cash flow for the year-to-date YTD 2025 totaling $1.24 billion. This figure demonstrates that the entire $1.2 billion annual dividend commitment for 2025 was already covered by FCF generated in the first 9 months of the year, providing a significant buffer. This coverage occurred even as the company progressed through its intense CapEx phase, $2.8 billion to $3.0 billion total 2025 CapEx, and before the expected Q4 production peak of 430 kBOPD. Structural cash flow neutrality. VAR Energy's long-term strategy provides resilience against unexpected commodity price shifts. Internal analysis projects that the company can maintain free cash flow neutral 2025 to 2030 with cash flow generation established at approximately $40 per BO. Given that the average project break-even is below $35 per BO, this $40 per BO floor suggests the operational structure provides strong protection, ensuring robust cash generation for dividends, deleveraging, and strategic flexibility, as long as market prices remain above this relatively low threshold. The fixed nature of the 2025 and 2026 dividend guidance acts as a critical bridge payment. It ensures continuous shareholder reward during the phase when maximum cash flow is being reinvested to secure long-term production. Post-2026, the dividend distributions are expected to stabilize and direct track post-tax CFO, benefiting from reduced decline rates and operational harvesting of the successfully executed growth projects. 5. Valuation analysis and peer benchmarking. A thorough valuation assessment reveals that VAR Energy is currently undervalued relative to its intrinsic cash flow potential, despite exhibiting specific valuation anomalies that require careful interpretation. 5A. Intrinsic valuation and analyst consensus. Intrinsic valuation methods suggest significant latent value in VAR Energy's equity. A discounted cash flow model performed by market analysts estimates the fair value of VAR shares at NOK 55.39. Compared to the recent share price of NOK 34.08, this calculation suggests a significant intrinsic discount, placing the company 38.5% below its fair value estimate. This intrinsic undervaluation is partially corroborated by the broader analyst community. Based on projections from 14 analysts, the 12-month average price target for VAR is NOK 39.14. Achieving this consensus target would represent a potential upside of 16.05% from the current price level. Relative valuation and peer comparison. VAR energy valuation multiples, when benchmarked against key NCS-focused peers such as Aker BP, AKRB, and Equinor, show a mixed picture that ultimately points toward undervaluation relative to its rapid growth phase. EV/EBITDA analysis. The enterprise value to earnings before interest, taxes, depreciation, and amortization (EV/EBITDA) ratio is the most favorable metric for VAR energy. At 2.4x to 2.5x, VAR trades at a significant discount compared to the energy sector average of 4.0x. While slightly higher than Aker BP, 2.2x, and Equinor, 1.7x, this multiple is low considering the company is on the cusp of a massive production and cash flow spike, 430 kbo EPD projected for Q4 2025. For a company undergoing such rapid, de-risked growth, a premium on earnings multiples would typically be expected compared to more mature, slower growth peers like Equinor. The current low EV/EBITDA suggests the market has yet to fully price in the imminent cash flow expansion resulting from the successful 2025 project deliveries, supporting the contention of market mispricing. Price-book anomaly. The most striking feature of VAR energy valuation is the high price-to-book (PB) ratio of 8.5x. This is substantially higher than peers like Aker BP, 1.3x, and Equinor, 1.5x. Typically, such a high PB indicates that a stock is extremely expensive relative to its physical assets and book equity. However, this statistical anomaly likely reflects the market's strong belief in the underlying quality of VAR energy assets and its future earnings potential. The vast, low-cost resource base, 2.1 billion BOE, and the industry-leading operational efficiency, $10 per BOE unit cost, are seen as highly valuable, predictable cash flow generators, whose economic value far exceeds their historical book value. The market is assigning a substantial premium to the de-risked nature and longevity of these NCS assets, indicating that VAR energy is best valued using cash flow metrics, EV/EBITDA and DCF, rather than traditional PB analysis. The high PB signals market confidence in the high return on equity generated by the company's capital allocation and operational expertise. VI, risk matrix and mitigation strategies. While VAR energy benefits from strong operational fundamentals and a stable jurisdiction, specific geopolitical, regulatory, and commodity risks must be managed. The company has implemented explicit strategies to mitigate these risks, particularly concerning taxation and price volatility. VIA, regulatory and tax risk, the Norwegian tax structure. The most significant structural risk faced by E&P companies on the NCS is the stringent fiscal regime. Norway imposes a high combined 78% marginal tax rate on the petroleum sector, comprising a standard corporate tax, 22%, and a special petroleum levy, 56%. This high nominal rate, if applied to gross income without relief, would severely undermine profitability and investment incentives. Mitigation via cash flow tax system. The primary mechanism for mitigation lies in the structure of the special petroleum tax, which has been converted into a neutral cash flow tax. This system operates on cash flow principles, allowing the company to claim the immediate deduction of all capital investments, CapEx, against the tax base. The strategic implication of this structure is profound. VAR Energy's substantial CapEx spending, up to $3 billion in 2025, provides an extremely effective tax shield. By immediately deducting these investments, the company effectively minimizes its taxable income during the peak development phase, securing cash flow for immediate shareholder distributions. This mechanism ensures that only the genuine economic rents generated by the field are taxed at the high 78% rate, while companies retain sufficient returns to justify continued high investment on the NCS. Regulatory uncertainty. While the NCS petroleum regime is well established, international investors must note that regulatory risk has marginally increased. Recent actions by the Norwegian government, including the introduction of resource rent taxes on other domestic industries like aquaculture and onshore wind, have created a perception of a more unpredictable investment climate. Investors must monitor any future policy changes that could potentially alter the petroleum tax framework or impact the immediate deductibility of capex. VIB, Commodity Price Volatility and Hedging Strategy. The cyclical nature of global commodity markets presents a perpetual risk to cash flow stability. VARRY has adopted an aggressive and highly effective hedging strategy, particularly for crude oil, to lock in sufficient revenue to meet its fixed dividend commitments. Crude Oil Hedging Program. As of Q3 25, VARRY had strategically hedged approximately 100% of its post-tax crude oil production until year-end 2025. These hedges are implemented through put options at a strike price of $50 per BOE. This comprehensive hedging strategy provides an explicit revenue floor, guaranteeing a minimum level of post-tax CFO through the end of the year. This financial security is critical as it structurally underpins the fixed $1.2 billion dividend commitment for 2025, regardless of any short-term severe decline in global crude prices. Natural gas hedging. For natural gas, the company also engages in fixed-price transactions. As of Q3 25, 15% of the company's Q4 gas production was sold under fixed-price contracts at an average price of approximately $78 per BOE. This strategy ensures price predictability for a portion of gas volumes, complementing the strong realized prices achieved during Q3 25, $90 per BOE, for 18% of volumes. 7. Conclusion. VARRY has successfully navigated a crucial transformative phase, establishing itself as a uniquely positioned investment vehicle in the European E&P space. The analysis confirms a strong operational foundation, highly favorable project economics, and a cash flow profile robust enough to support fixed, high shareholder returns. Investment summary. The company has successfully translated a significant investment cycle into highly de-risked future production volumes. The strategic delivery of major projects, John Castberg, Jotun FPSO, ahead of schedule, ensures that the Q4 2025 production peak of 430 kBo EPD is achieved, securing the long-term production plateau of 350 to 400 kBo EPD toward 2030. This growth is underpinned by an industry-leading cost structure, with unit production costs targeting $10 per BOE and project break-evens below $35 per BOE. The financial structure is fortified by the strategic use of high capex to effectively shield income from the 78% marginal tax under Norway's cash flow tax system. This allows VARRY to generate substantial post-tax free cash flow, providing structural coverage for the fixed $1.2 billion dividend commitment for both 2025 and 2026. Near-term commodity risk is aggressively managed through 100% hedging of post-tax crude production at a guaranteed floor of $50 per BOE through year-end 2025. Final justification. The current market valuation of VARRY does not yet fully reflect the predictability and volume of its imminent cash flow expansion. While the price-to-book ratio suggests the stock is expensive, the low EV/EBITDA multiple 2.4x to 2.5x and the 38.5% intrinsic DCF undervaluation suggest a significant mispricing relative to its operational strength and proven capacity for resource conversion. VARRY offers a rare combination of de-risked volume growth and secure high dividend yield, positioning it as a mandatory holding for institutional portfolios seeking stable income and capital appreciation in the European energy sector.